Why do different currencies have different values? I mean, isn't money just money? A dollar is a dollar, a peso is a peso, and a yen is, well, a yen. But why is it that $1 might be worth 150 yen, or 20 pesos, or less than £1 British? Who decides that? And why does it matter? Let's start from the beginning. Imagine you're on vacation, and you go to exchange your dollars for euros. You hand over $100 and get back, say, 90 euros. That exchange rate, the value of one currency compared to another, changes all the time. But why? Well, think of currency like the price tag of a country. It reflects how strong or weak a country's economy is compared to others. If your currency is in high demand, it becomes more valuable. If people aren't that interested in it, its value drops. So what makes a currency more or less valuable? First, let's talk about supply and demand. This is Economics 101. The more people want a currency, the more valuable it becomes. If everyone wants Japanese yen to buy Japanese cars, visit Tokyo, or invest in Japan's markets, the demand for yen increases. And if there's a lot of yen available, but not many people want it, its value goes down. It's like anything else you buy and sell. The rarer and more desirable it is, the higher the price. Now, why would people want a particular currency? One big reason is interest rates. If a country's central bank offers high interest rates, investors might want to move their money there to get better returns. But to do that, they need to buy that country's currency. More demand equals higher value. Then there's inflation. If a country has high inflation, the value of its currency tends to drop. Because your money buys less stuff over time, people trust it less. On the flip side, low and stable inflation usually helps keep a currency strong. Another factor? Economic stability. If a country is politically stable, has good growth and seems reliable, investors feel safe parking their money there. That increases demand for the currency. But if there's political chaos, corruption, or a shaky government, investors might back off and the currency can lose value fast. And let's not forget trade. Countries that export a lot often have stronger currencies because other nations need to buy their goods. And to do that, they need to buy the exporter's currency. So, if you're buying a ton of electronics from South Korea, you'll need Korean won. Okay, now here's where it gets a little more complex, but still very interesting. Floating versus fixed exchange rates. Most major currencies like the dollar, euro, and yen have floating exchange rates. That means their value changes constantly based on market forces, supply, demand, news, politics, and economic data. But some countries peg their currency to another one. For example, a country might fix its currency to the US dollar at a set rate, like 1-to-1. This can help keep things stable, especially for countries with smaller or developing economies. But it also means they have to work hard to maintain that peg, using their reserves and adjusting policies. Now, here's something curious. Sometimes a weaker currency can actually help a country. Wait, what? Isn't a strong currency always better? Not necessarily. If your currency is cheaper, your exports become more affordable for other countries. That can boost your economy. Think of it like a store putting items on sale. If everything is cheaper, more people buy. So, countries sometimes let their currency weaken to make their products more competitive globally. Of course, it's a balancing act. Too weak and it can cause inflation and scare away investors. Too strong and your exports suffer because they get too expensive. You might have also heard about central banks intervening in the currency market. What does that mean? Well, sometimes a country's central bank will buy or sell its own currency in large amounts to influence its value. They do this to stabilize the economy, support exports, or control inflation. Currencies are also affected by speculation. Traders in massive financial markets are constantly buying and selling currencies based on predictions, news, and trends. Their actions can move currencies up or down quickly. Sometimes it has little to do with a country's actual economy, and more with how people feel about that economy. Now here's a simple analogy. Think of currencies like apples. If everyone wants apples from one specific farm because they're tasty and reliable, the price of those apples goes up. But if rumours spread that the apples are rotten or the farm might close down, the price drops. Currencies work in a similar emotional and economic space. So let's recap. Currencies have different values because of interest rates, inflation, trade, political stability, and how much people want to use or hold that money. Add in speculation, central bank moves, and different exchange rate systems, and you've got a pretty complex mix. But at its heart, it's all about trust, supply, and demand. That's why a US dollar, a euro, and a rupee don't have the same value. It's not about how colourful the bills are or who's on the front. It's about economics, behaviour, and belief. And once you understand that, it changes how you look at the global economy. It's not just numbers on a board. It's a living, breathing system where currencies compete, cooperate, and react every second. So next time you hear that your currency fell against the dollar or hit a new high, now you know what that means. It's not random. It's not magic. It's economics in action. And hey, if you've ever wondered why your vacation suddenly got more expensive or why imported gadgets cost more this month, it might just come down to these invisible currency battles happening in the background. So yeah, different currencies have different values. And now, finally, you can say, now I get it.